Hey everybody, welcome to my YouTube channel where I talk about economics, finance, and everything else that I'm interested about. In today's video, we will be talking about the wealth tax. Now before we get started, I want to emphasize that I'm not against taxes. A lot of people are going to leave comments saying,
tax the rich, tax the billionaires, the rich keep getting richer, down with the rich.
But I just want you guys to know that this is just my opinion and my narrative on what the wealth tax is. And besides that, the minimum net floor for the wealth tax is $50 billion, which I am nowhere near. I plan to be in the future, but currently I am nowhere near that. My primary objective is to educate everyone to know how this may actually affect everybody, not only millionaires and billionaires. Let's just dive into it with some background. A wealth tax is to combat income and wealth inequalities. The plan is to take households with a net worth over $50 billion and tax them by 2% annually, and then other households with $1 billion net worth and tax them by 3%. What the government plans to do with this tax revenue is to take it and put it into the Medicare for All plan. However, this will affect capital gains, inheritance, and financial transactions. So we have to ask ourselves, has this ever happened before? And the answer is yes. In the EU, a wealth tax was imposed. However, it did not stand for long. Subsequently, there was a bad administration, and also there was low efficiency in raising revenue. And another reason that it didn't last was because a lot of the billionaires that were living in the EU decided to take their money, liquidate their assets, and go elsewhere. With the new tax plan, there is a penalty of 40% to if you want to leave the country and go elsewhere. Now, let's jump into the economics of it. GDP, gross domestic product, consists of consumption, government expenditure, investment, and net export. So you might be wondering what actually goes into GDP. Well, GDP is a monetary or market value of all finished goods or services that go into a country. So now, if we look at America's GDP, we know that we are a consumer-based economy. About 70% of our goods and services are consumer-based. And coming in number 2 is our investments. We spend about 18% of our GDP into investing. And so with that knowledge, there is an underlying issue. This might discourage domestic savings and investments, which will reduce capital accumulation, thus weakening our economy and our long-run economic growth. So now, let's use some real-world examples and apply to our theory. Let's use Elon Musk as our example. With this tax plan, he will owe Now, 4.6 might not sound a lot when you compare it to his overall net worth. However, I want you to think about it like this. If Elon Musk creates a new Tesla factory for however much, that 4.6 could be going into those factories and creating a new facility, thus leaving Elon Musk to open up less factories potentially. And this can have a rippling effect on all of the new college graduates, people who didn't go to college that Elon promotes to work at his factories, and even a plethora of other staff that work at these factories. So this does have a rippling effect on everyone underneath. And this could affect you. So this is something that we really need to look deeply into and look at the underlying effects of wealth taxes. So let's get into the part of the video where I express my opinion on the wealth tax. Again, this is just an opinion. I don't have 50 million in my pocket or in my net worth, so this really wouldn't affect me on a macro scale, but I do believe that there should be some sort of new tax applied. Possibly to capital gains. I believe that those should be taxed on a higher level. And if you don't know what capital gains are, pretty much it's just taxes that are paid on assets that you liquidate. A good example is when you buy a stock and hold it, you don't pay capital gains stock until you sell that stock. However, capital gain stocks or assets must be held for at least 1 year. Anything held for under 1 year is subject to a different tax percentage. The capital tax percentages vary per individual. They start from 0% to 15% to 20%. These percentages go based off of how much you earn and how you file your taxes. So now think about it. Someone that's making $40,000 a year can legally get away with paying 0% of capital gain tax. However, on the flip side of the coin, someone that has $50 million in capital gains assets will have to pay the same tax bracket as someone that has $50 billion in capital gains assets. The individuals who have 50 million should be paying a lower tax percentage than the individuals that have $50 billion. Well, that brings us to the end of my video, guys. I hope you really enjoyed and learned a little bit about wealth tax. Be sure to like, subscribe, and leave a comment down below for other things that you would want me to go over or discuss. And until next time, guys, stay smart.